Today we are going to record our lesson about the national income statistics. This is meant for both AS girls and AS boys. And this was also done in our AS boys class, but right now they can also get the benefit of the same lesson as it is meant for AS girls. So, what is meant by the national income? Yesterday, we were talking about the macroeconomy as a whole. What are the different objectives of the government in the macroeconomics? So, right now, one of that objective of the government is the national income growth. Now, the point is that how to measure that national income, that which is going to have its growth over the period of time. So, first of all, we have to know about what the national income is, and then what are the different statistics which are being used to measure the national income in an economy over the period of time, and how it can be used for different purposes, like what is the GDP tax ratio, and what is the GDP debt ratio, what is the GDP current account deficit ratio, trade deficit ratio. So if we measure national income accurately, or more or less accurately, then all our other national statistics will be in accordance to this national income. And if its measurement is a wrong one, then all our economic policy failure will take place, that our national income is wrongly measured. So it is very important to measure national income more or less equally. Keep it in mind that there is hidden economy or gray economy in every economy of the world, which is undeclared economic activities, which are even present in US economy or in many of the European countries economy. But right now, as a white paper, we can see what is meant by national income. So this is the income of the whole nation. So what is meant by whole nation income? That whatever the income is earned by all the factors of production in the country, that is added up to get the measurement of the national income. It tells us how much national income or national output is produced within a given year. There are different statistics to measure the national income. First of all, we will find that GDP, that is meant abbreviation of gross domestic product, GNI, gross national income, NDP, net domestic product, NNI, or net national income. And then we will be doing the nominal GDP and then real GDP. This is our agenda for today's lesson, that we are going to discuss all these six national income statistics to measure the national income in different ways, and what are the differences among them. This is the main thing. GDP or gross domestic product means, gross means total, domestic means within geographical boundaries of a country, and product means the final output produced by a country in a given year. So GDP, its definition, it is a total value of final goods and services produced by a country in a given year. So I will make it bold, that what is meant by GDP. So it is the value of all the final goods and services produced by a country in a given year. So we measure its value in a fiscal year. Fiscal year means that starts from, in Pakistan it starts from July 1st, like nowadays it is fiscal year, that is that has started from July 1st 2024. All right, so it will lost in 30th June 2025. So within this time period, how much output is produced by a country, that is included in our GDP. So GDP is measured at the factor cost prices. You might be knowing that the market prices are inclusive of indirect taxes. So taxes are not part of the income of anyone in the economy. This is the revenue of the government on the economic activities performed by the economic agents. So we exclude taxes from the prices, and we will get the factor cost prices at which the factors of production they have produced the output. So indirect taxes are excluded, and then we will add the subsidies if any. These taxes are not part of GDP. We will measure GDP at the factor cost. And how to measure the factor cost value? That is the market price minus indirect taxes, subsidy if any is provided by the government, then it will be added. So then we will be measuring the GDP at factor cost. We measure GDP of the final goods, not intermediate goods. For example, if we take into account wheat, flour, and bread, then there will be the GDP which is overstated value. Like wheat is having a value of 1000, then when it is converted into flour by the flour mills, its value goes to 1500, and when it is converted into bread by the bakery, then its value will become 2000. So if we add them up altogether, we get the value that is 4500 value of GDP, where flour and wheat, they can be double counted. So it is overstated value. So we have to take either the final value of the output at which the goods are being consumed by the consumer, that is the bread which is finally consumed. So that is circled, the GDP value is 2000. So if we are not using this method of final value, then we will be using the value added method. Wherever the value is added, that is included. For example, now wheat was produced at 1000, then it is converted into flour by the flour mill, and its value is 1500. So 500 is value added to this wheat. So when it is converted into bread by the bakery, so again 500 value is added. So what is the value added tax? Actually, wherever the value is being added, at each stage of production, government will impose a tax which is called value added tax. So it will be three stage tax, which is causing more inflationary pressure in the country, and it is more aggressive in nature. So you can see here, by the value added method, we reach to the same figure like 2000 by the value added method. And if we took the final value output, then it was also 2000. So that will exclude the double counting problem of measuring the GDP. So if we count the product price at each stage of production, it will have double counting problem. The value of GDP will be overstated. We use the value of final goods or the value added method to avoid double counted problem. So within country, all the output produced by a country within its geographical boundaries, either it is produced by the nationals or foreigners within our country. Like many of the multinational companies like KFC, McDonald's, and many of the pharmaceutical companies, they have been producing output in our country. So that is included in our GDP. All right, because they are using our factors of production to produce the output. So we include that output in our GDP. Now come towards the GNI, or gross national income. It is the total value of the national income produced by the nationals of a country in a given year. Like GDP was including all the output, either it was produced by the nationals or by the foreigners within our country. Now how to reach to the GNI? We will use net property income from abroad. GDP plus net property income from abroad. So what do we mean by net property income? That means the foreigners who have earned income over here and they are sending that income to their homeland. So that is deducted from our GDP to get GNI. So whatever the Pakistanis, they are working abroad, many Pakistani multinational companies, they are working abroad and they are sending their profit to their homeland Pakistan. And so, or the income sent by the Pakistanis to their families in Pakistan. So those incomes are included in our GNI, okay, even though they have not produced within our country. So if incoming income is more than the outgoing income, then our GNI size will be more than GDP. And if outgoing income is more than our incoming income, then our GNI size will be lower than GDP. So this is how we reach to the GNI after calculating GDP. Now what is meant by NDP? Net domestic product. You all know that the capital goods, they are wearing and tearing, they are depreciating over the period of time. So if we deduct depreciation, we know that some of the national assets will depreciate over the period of time. We say depreciation is the capital consumption allowance. So if we deduct that capital consumption allowance from GDP, we get to GDP, NDP, net domestic product. All right. So this is about how to reach to net domestic product, which is the GDP measured, national income measured in our geographical boundary. So what is net national income? So it can be found by GNI minus depreciation. So when we calculated GNI, then deduct depreciation from that GNI, so you will reach to the net national income. This is the income of the all the nationals in the country. Okay, now what is meant by nominal GDP? Actually, nominal means at current year prices. When GDP is measured at current year prices, you will be knowing that current year prices might be increasing more than the increase in output in the country. So this nominal GDP is actually inclusive of inflation in our GDP value, so which can be overstated. So it is called nominal GDP, which is inclusive of inflation when GDP is measured at current year prices. So what is real GDP? Actually, real GDP means it is measured at the constant price level. It is exclusive of inflation. Now, how to get the real value of GDP out of the nominal GDP? If we have the nominal GDP value divided by the rate of inflation, so you multiplied by 100, so you will get the real GDP value. For example, our nominal GDP is $400 billion, but our inflation rate is 20%. So rate of retail price index will be 120. So nominal GDP is 400 divided by 120 into 100. So that will give us the real value of GDP, that is $333.33 billion. So it is called GDP deflator, that it has deflated the value of GDP from 400 to $333 billion. So actually inflation was overstating the value of our GDP. So we will measure it at constant prices, so real value will be lower than the nominal value. Now methods of measuring national income, there can be the three methods which are used to measure the national income. One of them is called output method, that is called GDP. Income method, that is called national income of all the factors of production which is earned by all of them. And expenditure method, so we will go through in detail in our typed lesson. So it is the measure of the value of final goods and services produced by a country in a given year. In order to avoid double counting problem, the government will adopt the value added method. The prices will be taken after deducting indirect taxes and adding the subsidies if any. So there can be the problem of hidden economy or gray economy. Hidden economy is that which is undeclared economic activities. For example, people are not declaring their exact value of income in order to evade taxes. Illegally they will be saving the taxes, or the economic activity itself is illegal, like smuggling income is there or bribery income is there, so people don't want to show or declare their income. So that is the hidden economy which is present now. That is the main problem in measuring the GDP. So income method, in this method we add the income of all the factors of production like wages and salaries, rent, interest and profit of the corporate sector. Keep it in mind, the transfer payments are not included in the income method. What are the transfer payments? Like pension, unemployment benefit, child care benefit, and many other things which are transfer of funds from, like Benazir income support program in our country. So these are only transfer of funds from one sector to another. There is no corresponding output is produced. That's why they are deducted. In expenditure method, we include the expenditure of all the four sectors of an economy. Like aggregate demand, we have C plus I plus G plus net export. So C stands for consumption by the household, investment, government spending, and then net export. So by these methods we will be measuring the GDP. So here I have found some of the relevant material for you people. GDP that measures the total value of goods and services produced within a country's borders over a specified period, usually a year. Formula is that consumption, investment and government spending plus exports minus imports. This is the main way how GDP is measured. Calculate GDP if consumption is 100 million, investment is 20 million, government spending is 30 million. So add them up and deduct the imports, you will get the value of GDP. Gross national income measures the total income earned by a country's citizens, including income from abroad. So GNI, GDP plus net income from abroad, Calculate GNI if GDP is 150 million and net income from abroad is 10 million. So it will be altogether 160 million, because income from abroad is positive over here. So net domestic product GDP minus depreciation, wear and tear on capital assets. So NDP GDP minus depreciation. Calculate NDP if $150 million is the GDP and depreciation is 20 million. So net national income, NNI measures GNI minus depreciation, so that's fine. So 20 marks questions I have also mentioned. So calculate the GDP of a country using the following data. So here it is given: 500 consumption, investment, government spending, exports and imports. So this type of question comes into your MCQ. So you should be well aware of these types of questions. So question number 2. Distinguish between GDP and GNI. Provide examples to illustrate the difference. 5 marks for definition and 3 marks for examples and 2 marks for explanation. So question number 3. Calculate the NNI of a country of its GDP. If its GDP is $1,000 million, depreciation is 150, and net income from abroad is 50 million. So you can find it easily. Explain the limitations of using GDP as a measure of country's economic performance. So you'll be doing it later on as we cover up the new topics. So compare and contrast NDP and NNI. Nominal and real GDP. Nominal GDP measures the total value of goods and services produced within a country's borders using current market prices. So nominal GDP is this sign. This sign is the summation sign. Those who are studying statistics, they will be knowing this is the summation sign, which is used to measure, to sum up the values, quantity multiplied by current prices. So real GDP means real GDP measures the total value of goods and services produced, adjusted for inflation or price changes using constant prices or base year. So sum of the quantity into base year quantity multiplied by the base year prices. Now key difference is price consideration. Nominal GDP uses current prices while real GDP uses constant base year prices. And base year is that where the prices of all the goods have remained constant throughout the year. So inflation adjustment, real GDP counts for inflation. Whereas nominal GDP does not count for inflation. Now what is the economic growth measurement? Real GDP accurately reflects changes in production volume. Nominal GDP reflects price changes. Scenario is this: country X produces 1000 units of product A in year 1. Price per unit $10. So nominal GDP will be $10,000. So real GDP at 2020 base year prices 8,000. Like we are having the price level at $8 instead of 10. So real GDP will be 8,000 instead of 10,000. So in year 2, price per unit 20% increase. Nominal GDP is now 12,000 and real GDP, that is base year prices, they are 8. So you will find this thing now, the real GDP will be 8,000 instead of 12,000. Comparison is there. Nominal GDP increased by 20%, indicating apparent economic growth. Real GDP remained constant at $8,000, showing no actual growth in production volume, because volume hasn't changed, only the prices have changed. Conclusion: real GDP provides a more accurate picture of the economic growth by adjusting for inflation, while nominal GDP reflects price changes. So here we find few questions about it. Distinguish between nominal GDP and real GDP. Use the following data. You will be using it, get its picture and do it yourself. So this is the whole lesson about the national income statistics. You will be finding it very useful, and we will do it later on. The rest of the things, if anything is unclear to you people, so we will be doing it in our class lesson as well. So right now this is the online lesson available on my YouTube channel as well. You will find more important things over there. Thank you.